Imagine for a moment that you walk into a casino. The lights are blinding, the music is hypnotic, and the air is thick with the smell of desperation and cheap adrenaline. You see millions of people screaming at slot machines, throwing chips onto velvet tables, praying for a win that could change their lives. But this casino isn't in Las Vegas. It isn't in Macau. And it isn't in Monte Carlo. This casino is the global economy. And whether you realize it or not, you are already inside. Your pension, your savings, the price of your groceries, and the future of your job are all chips on the table. For centuries, the purpose of a financial market was simple: to fund the future. You invested in a company so it could build a factory, hire workers, and create a product. Value went in, and real wealth came out. But somewhere along the way, the wires got crossed. The servant became the master. Consider this terrified statistic. The total GDP of the entire world, the value of every car manufactured, every meal served, every surgery performed, and every line of code written is approximately $100 trillion. That is the real economy. Now, compare that to the casino economy. Estimates suggest that the notional value of the derivatives market bets made on the future price of assets, bets upon bets upon bets, is over $1 quadrillion. That is a 1 followed by 15 zeros. 'Tis 10 times the size of the actual economy. There is a tumor growing on the financial system that is 10 times larger than the host it is feeding on. We are no longer using money to build civilization. We are using civilization to fuel a global gambling addiction. And history tells us that when the house of cards finally collapses, the gamblers on Wall Street get bailed out. But you, the innocent bystander, get left with the bill. This is the story of how the stock market detached from reality. This is the story of the casino economy. To understand how we ended up on the edge of this precipice, we have to understand a concept called financialization. It sounds complicated. It's actually very simple. Financialization happens when the pursuit of short-term profit through financial tricks becomes more profitable than the difficult, long-term work of actually producing things. Look around you today. You see a paradox that shouldn't exist. On one hand, you see stock markets hitting all-time highs. You see headlines about trillion-dollar valuations and record corporate profits. You see a booming economy on the news. But on the other hand, you look at Main Street. You see small businesses closing. You see wages that haven't budged while inflation eats your paycheck. You see infrastructure crumbling and a generation that can't afford to buy a home. How can both of these realities exist at the same time? The answer is that the stock market is no longer a reflection of the economy. It has decoupled. It has floated away into the stratosphere, powered by two very dangerous engines. The first engine is stock buybacks, a legal form of market manipulation where companies eat themselves alive to boost their share price. The second engine is derivatives, complex financial weapons that allow investors to gamble with leverage that would make a Vegas bookie blush. Together, these tools have turned the greatest capital engine in human history into a parlor game for the elite. But to see exactly when the game was rigged, we have to wind the clock back. We have to look at the moment the rules changed. Let's go back to the beginning. The year is 1602. The Dutch East India Company establishes the world's first official stock exchange in Amsterdam. The logic was pure. Ships were expensive. Voyages to Asia were dangerous. No single merchant could afford the risk. So, they pooled their money. They issued shares. If the ship returned with spices, everyone got rich. If the ship sank, everyone lost a little. The stock market was a mechanism to share risk and build capacity. It was tied to the physical world. For nearly 400 years, this principle held firm. But then came 1982. If there is a single year that marked the beginning of the end for honest capitalism, it was 1982. This was the year the United States Securities and Exchange Commission, the SEC, passed Rule 10b-18. Before this rule, if a company's CEO used corporate cash to buy shares of his own company on the open market, it was considered illegal. It was classified as market manipulation. Why? Because if you reduce the number of shares available, the price of the remaining shares goes up artificially, even if the company hasn't sold a single extra product. It was a fake pump. But under pressure from Wall Street lobbyists, the SEC changed the rule in 1982. They created a safe harbor. Suddenly, market manipulation was legal. It didn't happen overnight, but like a slow-acting poison, this changed the psychology of business. CEOs realized they didn't need to innovate to get rich. They just needed to take the company's cash and buy back their own stock. Their bonuses were tied to share prices, so they were effectively printing their own bonuses. Then came the second turning point: the deregulation of derivatives in the late 1990s and early 2000s. We all remember 2008. We are told it was a housing crisis. That's only half the truth. It was a gambling crisis. Banks hadn't just lent money to people who couldn't pay it back. They had created collateralized debt obligations, CDOs. They took those bad loans, packaged them, and bet on them. Then, other banks bet on those bets. When the housing market dipped slightly, the massive tower of derivative bets worth trillions came crashing down. It nearly destroyed the world economy. And here is the terrifying part: we didn't fix it. We didn't ban the casino. We just bailed out the dealers, gave them more chips, and told them to keep playing. If you strip away the jargon and the noise, you will see that the casino economy follows a very specific, repeatable pattern. It is a death spiral in 4 stages. Stage 1 is the injection. It starts with easy money. Central banks lower interest rates to near zero, or they print money through quantitative easing. The intention is to stimulate business to help the bakery buy a new oven, or the factory build a new line. But that's not where the money goes. Stage 2 is the extraction. Why take the risk of building a factory, which takes 5 years to turn a profit, when you can borrow cheap money and buy back your own stock today? The money flows into financial assets. Corporations stop being innovators and become financial engineers. They hollow themselves out. They cut R&D, they cut quality control, and they funnel all liquidity into the share price. Stage 3 is the leverage. This is where the gambling addiction kicks in. When standard returns aren't enough, the market turns to derivatives. Investors use leveraged borrowed money to amplify their bets. T. bet on the direction of interest rates, the volatility of currency, or the price of commodities. The market becomes a hall of mirrors, where the value of the bets dwarfs the value of the actual assets. Eventually, the company or the economy becomes a zombie. It is so loaded with debt and has so little real cash flow from actual production that it cannot survive a single bad day. It requires constant injections of new money from the central bank just to stay alive. It is the patient on life support who thinks he is an athlete because the drugs are making him high. We saw this pattern in 1929. We saw it in 2008. And right now, the indicators are flashing red that we are at the absolute peak of Stage 3. Transitioning into Stage 4. You don't have to look far to see the scars of this system on the modern world. You just have to look at the sky. Take the case of Boeing. For decades, Boeing was an engineering marvel. It was a company run by engineers, for engineers. If it's not Boeing, I'm not going. But over the last decade, the culture changed. The focus shifted from building the safest planes to returning capital to shareholders. Between 2013 and 2019, Boeing spent approximately $43 billion on stock buybacks. Imagine if that $43 billion had been spent on safety testing, on better software, on training, or on engineering R&D. Instead, it was spent to inflate the stock price. And when the 737 MAX crashes happened, and when doors started blowing off mid-flight, the reality was exposed. The company had been strip-mined by Financialization. The stock price crashed, destroying the very value the buybacks were supposed to create. But Boeing is just one example. The entire market has morphed. Today, We have a phenomenon called ODTE options, 0 days to expiration. These are options contracts that expire within 24 hours. This serves absolutely no investment purpose. You cannot invest in a company for 24 hours. This is pure, unadulterated gambling. It is betting on red or black. And yet, these short-term bets now make up a massive percentage of daily volume on the stock market, while the smart money on Wall Street plays this game. Using algorithms to scalp pennies and billions, the real economy suffers. We see a K-shaped recovery. Those who own asset stocks and real estate get richer as the casino inflates. Those who earn wages, the workers, get poorer as the cost of living rises to pay for the printed money. The connection between hard work and reward has been severed. In a casino economy, the hardest worker is the sucker, and the biggest gambler is the hero. Until, of course, the luck runs out. So, how does this movie end? What happens when the music stops? The danger of a $1 quadrillion derivatives bubble is liquidity. In a casino, if one person wins big, the house pays. But in the derivatives market, the banks are betting against each other. If one major player fails, if one massive bet goes wrong, and a bank cannot pay up, it triggers a chain reaction. This is called counterparty risk. Bank A can't pay Bank B, so Bank B collapses, which means it can't pay Bank C. When 2008, the government stepped in with billions to plug the hole. But today, the hole is in the quadrillions. The combined tax revenue of the United States, Europe, and Japan isn't enough to bail out this system if it truly unwinds. When the next crash comes, central banks will face an impossible choice. Option A: let the system collapse. The derivatives market implodes, wiping out pensions, banks, and corporate treasuries. We enter a deflationary depression that makes the 1930s look like a picnic. Option B: print money. Not billions, but trillions upon trillions. They will try to inflate the debt away. This saves the banks, but it destroys the currency. It leads to hyperinflation, where your money becomes worthless paper. History suggests they will choose option B. They will sacrifice the currency to save the casino. There is a saying on Wall Street: bears sound smart, but bulls make money. They mock the warnings. They point to the scoreboard and say the system works. But a system that requires infinite debt to produce finite growth is not a system. It is a Ponzi scheme. The casino economy has detached from reality, but gravity is a law that cannot be repealed by the Federal Reserve. So, what can you do? First, recognize the game. Understand that the stock market is no longer a thermometer for the economy's health. Second, focus on real value. Skills, tangible assets, and businesses that actually produce cash flow are the only lifeboats when the paper wealth dissolves. Don't be the chip on their table. The lights in the casino are flickering. The house is running out of tricks. And when the darkness comes, only those who are holding something real will find their way out. I'm Economy Rewind. If you want to understand the mechanics of the machine before it breaks, make sure you are subscribed. I'll see you in the next video.